I appreciate the chance to speak with you. Again, Dan O'Brien, I'm with Kansas State University. My office is actually out in Colby, and that has both advantages and disadvantages. I get to do frequent crop tours along I-70 back and forth, so that's an advantage. Plus, to me, it brings about all that much more the eastern-western dichotomy, if that's the right word, between crop conditions. And you really see it this year, especially on the non-irrigated corn out to the west. We'll see what the irrigated does as opposed to some of the really pretty good yield. What I think I've heard of in terms of pretty good yield prospects here in the east. So we'll see. Oops. Talk about a number of things. Let's take a look at weather first. First, we have a hurricane. Well, we had a hurricane and major rain come into this part of the world. And when you read reports of where crop damage or ag industry damage has come in, Florida, Georgia, on into the Carolinas, Tennessee reported quite a bit of rain, etc. And I don't know agriculturally how to quantify that yet. You read from sources that a lot of the mills aren't destroyed, but in Georgia, like 100 and some big poultry facilities damaged is what I hear. Of course, it's almost unquantifiable what's happened in North Carolina. Just the massive floods. I don't have any clue of what livestock facilities are. What's been done there. Basically, we're worried about the human toll at this point as much as anything, but no doubt crops, infrastructure, all greatly damaged here. I don't know how that will, other than it'll take it lower, what impact that'll have on crop yields or some aspect of our corn, soybean production down in there. But again, the main mass of corn, soybean production, of course, is over here in the rest of the country. So we have that to deal with, and quote, we'll just have to wait to see how all things work out. Probably Doug Bounds is here with NASS. We're not worried about enumerators going out in North Carolina right now. There are bigger things afoot, and I'm not trying to make light of it. Well, excuse me, going back. Note, anticipated dryness in major parts of Kansas, affecting wheat seeding in northwest, north central, south and through central Kansas, south central. Really not too bad of conditions as far as moisture goes right now in southwest, and which is abnormal compared to where we have been. You can see on down in here parts of Oklahoma and Texas also affected. Generally pretty dry. So if this was a map in July, we'd say, oh, this is terrible, but this is during harvest time, so it's probably going to help us get the harvest out. And then we'll deal with the consequences on soil moisture as we go forward in later time. And considering that we do through December, as we sit right now, anticipated to be pretty dry through the 3 I states, basically through the rest of the Corn Belt. I'm not sure what that will say with regard to agriculture, but so much of what we'll be dealing with in 2025 is yet to come past the first of the year. We'll see what the moisture is at that time. But fairly dry conditions for winter wheat that's been seeded, soft red winter also coming in. So that's a pretty resilient crop, and we generally, as long as it comes up, and we get a stand. We have the 9 live, I guess 7, 8, 9, 10 lives, however many lives we attribute to hard red winter wheat that comes through. So and as I understand, I think we're a little bit ahead on wheat seeding as we stand right now. Really, we're getting on the crop markets. We've had the general idea here in the U.S. that we have pretty good sized crops. And because of that, we're anticipating, we're just arguing about, not arguing, but trying to determine whether we have over or under 15 billion bushels. We have large crops. It's just a matter of what the final yields are and what some of the damages are around the edges. And because of that, and that's the case for both corn and soybeans, our two major crops, prices generally move lower, and with more than adequate quantities available coming in at harvest time. It brings to mind trucks of grain. Either in past years, you'd see long lines of grain, long lines of trucks outside of elevators. Now you see still lines of trucks out of elevators. A lot of them also going to their on-farm storage. Just a matter of how you look at it. But we're in this situation now where we're harvest has started. We generally have pretty sizable supplies, and we have moderate to low prices. The question I get of late is, well, is the harvest low in? And I tend to think that if it was only based on U.S. domestic supply demand, corn and soybeans, that we'd probably still be at risk and we probably still are at risk as we get into the depth of harvest to have lots of supplies coming in later and probably have lows. We're at risk to lows anytime here, October, November, in the midst of harvest. If anything, probably last half of November, when we're just flooded with grain you'd wonder about. However, as happens in the grain markets, we have these international issues coming into play. Even with large supplies, the challenges over the Middle East conflicts have affected the oil market, and all that much more now with corn and soybeans. We have a domestic energy industry component to those. So frankly, corn markets and soybean markets, through soybean oil, corn through ethanol, are being supported some right now by risk and uncertainty in the international energy markets. And that has to do with the conflicts between Iran and Israel at this time. So I don't want to, of course, as Glenn had said, we're outside of our lane if we're commenting on politics, but what we can talk about on the agricultural markets, the impact of the uncertainty that these geopolitical things bring about. So you got that at play. I would also say we've also gained some support in corn, particularly soybeans, had been till last year or so, of dry conditions, pardon me, in South America. Now there's those dry conditions have delayed plantings in that area. There are forecasts of some rain to come in about a week or so. So there's enough dryness there that some rain probably won't undo all that has happened down there. But yet, if I think it's fair to say that their intention, if they have a good crop, is to plant as much as they can, to produce as much as they can, and to gather as much of the world export market as they possibly can attain. So that's what their intent is. Really, right now, it's really just a matter of if the weather allows them to do that. And at this point, you've got concerns about planting their soybean crop in parts of Brazil in particular, and with those delays, it pushes the planting window for the next corn crop that follows that soybean crop later out into next summer, when they generally have more heat risk. So we've got that happening. I think that the psychology of that market is that, hey, we're concerned, and that ends up about 5 or 10, 15 cents right now. But you really don't feel the full force of that until you really follow through. You get out into December, January, February, and you have tangible production problems. So it's offering some support right now during harvest, but the big issues would come later on, off into the spring. And you bring in you're talking about the timing of when information comes into the market. You're getting at the challenges of how to advise farmers on storing grain or not. And it's undeniably, we haven't called storage enterprises speculative moves, but yet we're dealing with uncertainty. There's a speculative element, and it's well worn that we have seen seasonality, that we've come out of harvest and gained some, but still we're counting on these historic price patterns to give us a return to storage. So that'll be at issue. And I remember I'm getting seasoned enough, Glenn and Guy. I remember when, well, we might pay 4 cents a bushel a month storage. Now it's 5, 6, or 7 or something. So commercial storage has gone up. On-farm storage, it also is more expensive. So it's more of a challenging environment to make those storage decisions. And you keep moving on to other parts of the world. What's happening here in the Black Sea region, particularly with Russia and Ukraine's affecting, there's enough dryness there. And as you read reports, even from inside the country, unfiltered, that in Russia, they're anticipating significant cutbacks in wheat production because of weather primarily. Ukraine's having some being affected by that some. So you've got that in play. You had some earlier production issues up into France and coming and other countries in the EU that's reduced their production as well. So that's an issue. We've seen in the wheat market here of late an increase in exports, and that's been more than welcome. Now it's been at really low prices, but still we have seen some increase. You've got the last 2 or 3 weeks that the amount of actual shipments is ahead of the pace of what we need to meet the USDA projection. So, in wheat, especially for hard red winter wheat, with what's happened of late, you do handstands for things like that. We've had really lackluster, to be polite, wheat exports. So, and so I think part of that has to do with the world looking around and saying, this supplier, Russia, that's been so dominant in that market, is having a production problem, and it's coming over and impacting us at this time. South Africa also has an impact on the world export markets. Get into India and China, no major issues as of yet. Really, our questions of China have more to do with how much are they going to buy? And hopefully, are they going to buy from us or are they going to buy from Brazil? Here we go. In Australia, there was a guy, Guy Allen, my good friend from here at IGP, used to work over there. The reports in the last, literally overnight, they had 1 million metric tons lost due to freezes and whatever. So, I guess you put all those together, and so here we sit at harvest time in the U.S. Large crops coming, not a lot of optimism that just the size of crops will give us a lot of gains, anything higher in the market. But yet we have these international issues, both on ag production and coming out of the energy sector with geopolitical ties that are offering us some support. One other thing I'd say, so if you remember the last 2 or 3 years when we had the major run up that we've seen in all commodities, it had to do as much with the geopolitical issue over in the Black Sea region as any. So that's worth watching. The world gets roiled up. They lose their confidence that those supplies are going to be there when they want them. Then they start bidding up. And I don't know that right now we can say, well, that's going to happen. But the risk of that happening is growing. The risk of it's growing, and we're reading about it. We basically have 2 hot wars going on right now, over in that part of the world, Black Sea region, and over in here in the Middle East, and it adds to the volatility and uncertainty in ag markets. It's going on. So feed grains. In the interest of time, we're going to hit this hard and go quick. But all that said, if you have questions, go ahead and ask them. It works better to ask the questions now than to wait for later. But look at corn. From 2000, if you have an extended chart, you have that in your handout. If you go back to the drought of 2012-13, we were in prices way up in here, maybe $7, $8 thereabouts, an $8 top. It came down out of that and languished in this 2014 to early 2020 period, basically running from lows of about, well, the lows about 318, 348, something like that. Highs, when we did get high, we'd be at about 475. Most of the time we got the 4 to 450, we were pretty happy. But then we had this recent run, again, the Ukraine-Russia war, big part of that. COVID had disrupted things. I've come down off of that now, and with large crops again, we're back down now in this range. Closed yesterday. Well, this is early morning trade, but 429.5 here in the last, well, yesterday or early today had a low of 385. And if we didn't have these outside factors coming in, we'd probably get around 385. We've got these other things bringing worries into the market. You can see, of course, for the Dees contract, the most relevant, the pertinent one for us right now for corn, 429, and there's that 385 of late. And since then, we've worked our way higher. Still think that so much is going to depend on the October 11th crop production report and the WASDE report. NASS is out. Literally, they started a few days ago, but they're out in the fields right now doing their enumerated surveys around Kansas. And Doug Vance is here with NASS. Can talk with you about the details of that. So that's those enumerated surveys right now when harvest is starting or just about to start are really important. Then we'll deal with the issue of relatively low prices at harvest, and then your farmers, your clientele will decide whether to sell or to store. You know, that's where we'll be. We do have some carries in the market. This was yesterday's closes. Of course, these contracts are off. They closed out now. July closed at $4. September at $3.91. These about $4.25. 4.24 3/4 was yesterday's final close. To 4.41, you've got from where we were in September up to where we're at now. It's about 11 cents a bushel a month, but we haven't started harvest yet. From here on out, you've got a little bit of carry to November, December, and then about 5.5 cents, about 5 cents on farm storage that may cover commercial storage. As we said, if we're at 5 or 6 or 7 cents a bushel, it's probably not covering it. And again, a grain elevator would sit and say, I'm going to hedge that. I'm going to capture that. But a lot of our farmers aren't in the mode of doing storage hedges. You know, we'll look at 5 cents and say, well, gosh, we can move 10, 15 cents in a day. And so I guess we're more in the mode of leaving ourselves in a more risky, in a risk reward situation in the cash and futures markets as we hedge. As we handle storage. And that takes us, you look at our seasonal prices. This is a new crop futures and what they're saying in terms of their expectations of the actual pattern going forward. They're taking those same futures, turning them into a season average price with the basis estimate. So you see this bluish bar. That's typically seasonal average mode. And we tend from October, November, coming into September, October, risky mass September, October, to have large supplies and then to kind of tighten ourselves up. These are the season average prices. Robin, this is what you put together with season average price trends out of K-State Ag Econ. We tend to get into kind of a chokehold position in January, February, where how many Februarys have you sat there in the grain market and said, I hope someday that will actually move higher. And you just gets into the real doldrums of that time frame. And you see it in terms of typical seasonal movements. But then, so a lot of the grain that's stored, unless there's again, geopolitical issue, something happening, then we get out into March, April, May, and that's when we have more volatility. And if we do get a return to storage that's above just covering cost, then you tend to see that more April, May, June, when of course everybody's busy, but they hire someone to haul grain from their bins into town. That's at least that's the central western Kansas move. So we'll see. Right now, the USDA's projection for the prices for this coming market year are $4.10. The futures are about $4.52. So that's a World Ag Board decision. So right now, the futures are a little more optimistic, about 40 cents more optimistic than the USDA numbers. We'll see where that goes. In cash prices, we're given where we're at right now, the Topeka, Salina, probably where we're most concerned with. Cash prices in Salina about $4.10, 19 under Topeka, with anticipation of sizable crops up in the northeast part. Little weaker bid, 44 under. Here are the bids for next year. Interesting. This is off the 2025 corn, 457.5, about 439, 404, 439 Salina, 404 in Topeka. Those are certainly covering our direct cost of production. They're not covering about 450, 460, 470, not covering the full economic cost of land, paying a cash rent and buying machinery. So from a lot of you in here from a financial management point of view perspective, and that will come back into play. So what that means, we cover seed, fertilizer, and all that pretty well. But then what do we do for machinery? What do we do for land? And if the land's tied in as a cash rent, then that's an upfront expense. Suddenly you've flip that around a little bit. Yields for corn, key issue coming into play. We've had yields from 2014 on, gained about 0.8 of a bushel a year, and have kind of been flat for yields. And then we've had these tremendous conditions in parts of the U.S. and looking at 183.6 bushels per acre coming out of the September report. And we'll see what October says. If that number, because of these maladies in the east and other issues around, if that number, I think if it goes higher, the market will say, well, okay, it's high. We already knew it was high. But if it goes lower, 1 or 2 or 3 bushels, you're shaving 100, 200, 300 million bushels off of that. And if the usage doesn't change much, then you're taking it off ending stocks, and that can make a difference. And I'll talk about that here in a minute. And just to see where the yields are in terms of change from last year, this is the blended yield in Kansas, dry land and irrigated together, east and west, all in one pot, 131 bushels, up 10 from last year. But here's where the market's paying most attention to: 200 plus in Iowa, 200 plus in Illinois, 200 plus in Indiana, and 200 plus in Idaho. So maybe now we need to have the 4I states instead of no, that's probably not quite right. Anyway, point is, pretty awfully good yields. Over in here, you can see they were already not in the best of shape. This is September 1 before all that hit, before the hurricanes and rains hit, and they were already suffering yield-wise. And I understand that 70–80% of the crops were already taken off in some of these areas. So not a big issue. We're probably more worried about grain setting in storage. Are the bins out of the water? You remember where we were in this part of the world when Missouri flooded about 2 or 3 years or more. So to show you this real quickly, you wonder, well, all that ethanol, what happens to those DDGs? How do we figure them in? How do they affect the balance sheet? You can see here, corn feed usage in terms of billions of bushels, generally moving along pretty well, but there is a significant amount by the time you take those pounds of DDGs a 10% dry basis, figure their poundage versus a 56-pound bushel, and you can see significant amount of DDGs coming in and impacting the overall feed balance here in the U.S. Okay, so to wrap a ribbon around corn. So in general, you're looking at stocks to use from 2020 on, building from 8 to 9.2, 9.9, 11.7, and now over 11, 12. Higher stocks to use, more abundant grains, prices having come down in the last 2 or 3 years as we've accelerated the pace of building stocks relative to use. 654, 465, 410. And again, now though the futures are indicating more like 450. But I think that's probably geopolitical issues, all that input. They pay us economists to understand the current situation, but then if we think there's something else that could happen, that's what we're supposed to do. And this is what the USDA is saying. With 183.6 bushels per acre, there's that 410 they're projecting. Crop size 15.1, 50.2 billion bushels. And with crop maladies, other issues at play, you start shaving off from 186 to 182.1 or 180.6 to 179, still almost 2 bushels over the previous record high yield that we had. Then you're starting to impact crop size from 15 even to 14.9 to 14.8. You run this through the supply demand balance sheet, and you end up with then you're getting ending stocks from down to 1.9, 1.7.5, 1.6. Stocks to use tightening up even more, and prices more like, well, from 410 to 443 to 465. If we would get way down to that, a major surprise, you're above $5. 65% chance the USDA is about 2/3. They're probably right, but there's still downside risk on that yield with these problems we're talking about, and you end up and start to crunch things down, change stocks to use, and start to see 30, 50, 55, $1.40 price change. So it's going to matter what that October 11th crop report says, because we'll take that into these balance sheets and we'll see what our ending stocks are. Okay, just want to show you one thing quickly. The world less China corn. We talk about the adequacy of stocks, but yet when you take China's large stocks out, we're basically going sideways. We're not in a world market that just that's building grain bins and storing grain all over. We have enough for now. It's kind of a hand-to-mouth type of a deal. So we're not seeing a lot of changes at all in the core market. So it's a market that, yes, it's pretty low right now, but it's vulnerable. It's vulnerable. We're not building major world stocks. It's a vulnerable market. And you can see here that most of those stocks are reported to be in China. So here's the US, the world stocks without China. Here's total world stocks. All that's reported to be in China. Here's the difference between stocks used between the world and world minus China. And you can see, we're in a declining tight situation. So I guess I'm a contrarian. I understand why we're at where we're at right now. We've got a world situation. If we trust these numbers, that's been tightening up and tightening up and tightening up for our grains. It's not like we're just overwhelmed with grain. We have enough grain to meet our needs right now. I think that bodes, that puts us in a situation to be wary of market volatility in the coming years. So we'll see.
Dan, 15 minutes.
15 minutes, thank you. Next, we're relying on Mexico. Just wanted to show you their imports versus production and dry conditions. last year, and you can see it reflected in the reports. Let's move along. Well, South American corn growing strong. No, really, in their view, no end in sight other than weather. And you can see a little bit of the anticipated production cutbacks in Ukraine and Russia. Okay, just want to show you something quickly on sorghum. Sorghum's coming in spot cash prices. It's more of a Western Kansas situation. I don't know that you have as much here other than maybe in North Central. As you can see, the big issue with sorghum is that whether China, which buys about 95% of U.S. spring sorghum exports, is active in the market. And they're in and out. And I think right now they're kind of out of the market, waiting for the next harvest to come. Okay. Take a look at wheat and soybeans. The time we have left for wheat. We're far enough to the east that if you go from here to Kansas City, it's probably not much wheat. You go from here to Salina, you still have quite a bit of wheat. So how many of your customers are active in a major way in the wheat market? Okay, good. Enough that we'll talk about it. So just quickly then, for wheat, you can see that this chart almost mirrors that corn. You can see the lows of where we were in that 14 through 20 time frame, jump up, especially heading towards $15 on the high side. The world was really worried about Ukraine wheat coming out, and that Russia would have sanctions, effective sanctions that would stop them being a supplier. Came down off of that, and now you're at latest close is 606 after a low about 527. Wheat, hard red winter wheat, these contract has lows 527. Again, these worries, the Middle East, etc., coming in, getting us basically back to $6. We'll see where this goes. Some carry in that market. You see, this is on yesterday's closes. September's out at 579. That's off the board now. These 598, 614, 624, 630. So you've got 6.5 or so cents a bushel. I don't know that many people are still holding wheat. Elevators might be, but I don't know that many farmers are still holding them. And that we're in the mode right now for wheat seasonality where we're just pretty sideways. And those of you that grow a lot of wheat or deal with customers that grow wheat, you probably wonder about when our price is going to change. Well, they tend on average to be pretty flat. Once we get to market, they're pretty flat. And I think our thunder in the wheat market has been taken a lot by what's happening with these other major wheat exporters, especially in Russia and Ukraine. We're not, most of the time, the primary first call place that the world's going to buy wheat. And you can see prices here for harvest, right? Well, pardon me, cash price is 558, 529, and generally that cost structure is 6 to 650 or more generally. Same situation on covering direct costs versus full economic costs. New crop bids for for July, 573 for Topeka, the high in the state, 573, pretty high. Then Salina, Hutchinson, 578. A little less off in other parts of the state. So, and this is with some pretty decent 3 or 4 weeks in a row of pretty good exports. So, if the world market starts to move, it'll have a positive impact on that. The first place we'd see it is probably in these export-oriented locations in Kansas, Hutchinson, Salina, Topeka, where the terminals are. Okay. 10 minutes, thank you. I don't know how many acres we're going to have planted for hard red winter, but it's lower prices probably haven't encouraged much. I'd be surprised if we saw a 10% gain. I wouldn't be surprised to see a 5% decline. So that's sort of where you'd think where we're probably at for wheat. Just prices haven't been that tremendous. You can see the pace of exports generally doing decently, turning up a little bit here of late, comparing it to other marketing years, just on a weekly basis. Weeks since the total cumulative exports. Hard red, here was that last year, just really a rough, brutal year for Kansas, pardon me, for U.S. hard red winter wheat, much less Kansas, and a little bit better this go around. You can see wheat generally exports been declining some as compared to our glory days back in here. Little lesser exports. A lot of it has to do with world competition. And so where wheat's at, we've got generally increasing stocks or more abundant stocks, prices having come down from highs back in 2022-23, 883, 696, 570, and all that in play. So before I move off of wheat and go to soybeans, what drove the world wheat market to this had to do with the geopolitical things. And here we've got geopolitical things that are happening and we have hard to contain, that we're afraid to even price. So the wheat market has again, when you get ending stocks over time, sideways to lower. Stocks to use for wheat from 25% several years ago for US minus China down to 18, almost as low as back in 2007, 2008. So we're not optimistic right now, given what we've just seen in the wheat market, but yet it's tight. It's really tight. And we have geopolitical things involving, hot wars involving the Black Sea region, much less what else could go on over there. So I'm not saying that, gosh, things are going to explode, but we have more of these geopolitical issues are coming in and can affect these commodity markets in a way that a year from now, we'd say, well, what just happened? So when your people plan on that, I don't think they can plan on a geopolitical war, bailing them out in the markets, but just be aware that these outside things are at play. Okay, let's go on. Take a look at, this is soybeans. We'll close with that. Minutes. So for beans, again, almost the same chart, just change the scale. 2014, your 20, pretty prices $8 to $10.50, basically. Have jumped up with impacts from South American production, dry year or two in play. The general run up in commodities have come back down now. We had a low of 9.32 in August. Are setting over $1 higher than that right now that'd be the November contract. And got large crop coming on. Generally, that would take things lower. But again, you have these energy market issues at play, supporting things. See where we're at? We've got about 5 minutes.
6 minutes.
6 minutes. Okay, good.
Prime rib's ready. So,
man, economists don't.
I put the pressure on here.
So thank you. Anyway, you see, we were at a low of 9.55, are over $1 higher than that now with these different issues in play. And I think that's Brazilian dry conditions and these world bioenergy things. If we're so now into biodiesel and renewable diesel that if there's oil problems from suppliers in the world, where do we go? We ramp up domestic renewable diesel production. So we're all in the energy markets now. A little bit of carry in these markets, 31 cents from September to October, but kind of losing some of, 9 cents a bushel a month, 7. This covers commercial storage, but in the view of most Kansas soybean producers, are they going to lock in over 2 months 18 cents a bushel when they see in a day it can go 20? That Now, an elevator, a business that can't handle that futures risk, they'll hedge that. But what do ag producers do? We tend to go more in the cash market and see what our opportunities are. And for soybeans, we have a little bit more of an uptrend. The futures are tending to follow that right now. So we generally sit here in October, see a little bit of gain through this time frame. It does narrow up some, but there's more South American influence in the soybean market than there is for the wheat. Prices, spot cash prices, Topeka 1006, 1033 for next fall. So we're covering costs generally pretty well there. But you see soybean yields, not as much of a distinction between current yields and where we've been in the past. Still pretty strong yields. We'll see again what the October 11th crop production report tells us. 60 bushel yields, Iowa, Indiana, Iowa, Illinois, Indiana. And I think the market sees that and pretty good yields elsewhere. What I would wonder about is what happens off of here. How weak do some of these things get in other parts of the country? China's dominator in terms of what's identified and unknown. A fair amount of that ends up going to China. Matter when they put the name on it. So there's a lot riding on the U.S. not being in conflict with China as far as trade goes. You see the domestic crush moving higher, exacerbated, grown more by renewable fuel, biodiesel coming in. Exports staying pretty strong. So here we go. When you see the percent stocks to use, we went through a time frame. It's 5-6%, not much. High prices. Now we've grown to about over double that, and prices have fallen off about $3, $3.50. This is the last slide, then, Rich. So this is what the USDA is saying: 53 bushels per acre. And again, there's more concern with recent dry weather on how soybeans finished, but probably more likelihood than for corn that the final numbers could be more like 52, 50, 51, thereabouts. And you do see some impact on prices if you shave that production down some, drop ending stocks, and see prices move to the high side. So we'll see. Well, thank you very much for hearing me out. Do we have a couple minutes for questions?
We do.
Okay.
Go ahead. Anybody online, if you have something, go ahead too.
So you spoke about the US's relationship with China regarding like soybeans. Can you talk to like what South America's relationship with Brazil put into
Repeat the question.
The question had to do with the relationship of the U.S. with China with regard to soybeans and frankly other crop and corn sometimes too, as opposed to what Brazil's relationship. And then we can lump, I think, Brazil and Argentina both in there, particularly Brazil, though. Generally, there's a revealed preference, some of it's for political purposes, of China to buy from Brazil as much or as long as they can before they would come to the U.S. I think, and I would say that because of the quantity of soybeans that they grow, the U.S. is kind of the prime, it has the front position in terms of being availability about 4 months of the year now, and Brazil, because of their quantity, has the other 8. And so there have been a number of times when you'll read the market analysis and they'll say, well, Brazilian soybeans are X dollars a bushel converted lower than the U.S. And their currency's a little bit weaker than ours has been. So that's been part of it. But so what's that relationship? China will buy, it's been a revealed preference issue. They've tended to buy from Brazil first and us when they have to.